Joe Higgins, let's go around the bond world and start off with high yield. It's had a tremendous run since February, but is it too pricey now? And also, is it set to fall because oil has been falling back down?
That's true, Greg. It has been an incredible run. In our view, the bottom rungs of high yield are too pricey, the triple C kind of bonds that are levered, 10 times. The higher quality high yield is not overpriced, though, because a recession is still, in our view, a ways off, 1, 2, certainly probably 2 or 3 years. And financing is cheap, so there remains some value there. We also have newer players entering the field in greater size. A lot of insurers are potentially adding more in the way of quality high yield at this point. So it has a ways to run, but it's a good time in our view to trim the riskiest and add the higher quality.
And what about emerging markets bonds? Typically, when the Fed raises rates, that hurts emerging markets. A lot of people think we can get that rate rise pretty soon. What's your view?
That is a classic relationship, certainly, but we're also probably going to have the slowest rate rise in history, more or less. So we think emerging markets can get through this relatively unscathed. They've also had a lot of time to prepare because it's been a while that people have been talking about it. So the diversified benefits of emerging markets, less correlated, for example, to high yield and U.S. corps, means they're still worth having, and they'll make it through the rate rise in our view.
And you also own asset-backed securities in the TIAA-CREF Bond Fund. In your view, these are fairly rich now. Can you talk about how rich?
They are rich in that they're fully priced, and they're nearly always rich. They've really been rich for the last few years in our view, but what's nice about them is they're diversifying against corporate debt. That's a key theme in our view. At a late stage in an economic rally, you want diversification. You want to cut off the most extreme parts of the debt markets. High quality, tend to be deleveraging at the short end of the curve. We like them. It's worth paying up for them at this stage of the cycle.
All right, we're really going around the world here, so let's go next to bank loans. What's your view?
Leveraged loans, like high yield, offer value, probably a little bit more value in our view right time. At this time, they're floating, so if rates were to rise, you have that benefit. They're senior secured, so if we were to have a recession, if you want to take either end of the risk spectrum, they're likely to do well there. And you cited oil earlier, Greg. They're much less exposed to oil than high yield bonds, 2 to 3% area versus 20% for bonds. So we think they're a go.
All right, and then what about munis? Munis had a great year last year, and they continue to be a place where people are seeking safety and yield.
Yeah, munis are rich as well. We like diversification within even the muni space, so revenue bonds as well as GO, water projects, power plants, and the like. Again, at this stage of the cycle, what we want is asset classes that will move somewhat independently. If we have a shock or eventually get to a recession, we think they're less correlated with IG corporates, high yield, and obviously EM. So still worth paying for.
All right, and speaking of a shock, we had Brexit not too long ago. So what's your view on Europe, both corporate and sovereign, going ahead post-Brexit?
Well, we've been amazed at the incredible recovery in spread product out of Europe. It looks like the bulk of the issues are going to fall on the UK in terms of potential for economic weakness. The European continent's economy is really not doing that badly, but yet demand from the ECB is likely to keep rates certainly low, if not somewhat negative as they are now.
And finally, let's bring it all back home. Right now, the 10-year Treasury is about 1.57, almost 1.6%. That's the yield. So what's it going to be at the end of 2016? What's your view on Treasuries?
Well, our general view is that the economy is going to remain relatively strong, but the U.S. rate and Treasury curve is really dependent upon global events, which are not going to come around as quickly. So my view is something in the 170s, not over 2% at year end. Not calling for what some people have said, 1%, sub 1%. We think the economy will be strong enough that we don't go there.
All right, well, thanks a lot, Joe Higgins.
Thank you, Greg.
Thank you for watching The Street.